Imagine that it's 2011 and you invested 1 lakh rupee in PSU bank index that include bank like SBI, Bank of Baroda, Punjab National Bank, Canara Bank, Union Bank and so on. Do you know what would be the value of investment after 10 years? Well, before COVID, in February 2020, your 1 lakh rupee of investment in 2011 would have become 60,000. Yes, that's 40% wealth erosion in almost 10 years. However, the same 1 lakh, if invested in PSU banks index during the COVID low, it would have become 6.5 lakh rupee. That's 550% return in 4 years. That essentially summarizes the fall and rise of PSU banks in India. 40% correction for 10 years and then 6.5 times return in last 4 years. On the other side, 1 lakh rupee invested in private bank index in 2016 that include banks like SDFC, ICICI, Kotak, Axis would have doubled your money by 2019. However, that same 1 lakh invested during COVID lows in private bank would have become 2.5 times. While 2.5 times is a good return in 4 years, what is staggering is during the same period, PSU banks have generated 6.5 times return. That's sheer outperformance. Hey everyone, recently I did a video on IT sector and discussed whether this correction in FY25 would create buying opportunity in the IT sector or not. And I received a few comments to do a similar video on the Indian banking system. By the way, if you have not watched my previous video, I would strongly recommend watching it. In today's video, I want to discuss one of the hottest topic of the street, private versus PSU banks. If you look at PSU bank index, it literally tanked 40% between 2011 till 2019. And if you add COVID correction, it was down 75%. However, PSU bank index rose like a phoenix from the ashes and zoomed 550% over the next 4 years. Meanwhile, private bank index that was the darling of every investor jumped only 150% in the same period. The question is, what just happened here? Why PSU banks that underperformed for 10 years suddenly outperform private banks by such a huge margin? More importantly, from here, can PSU banks still continue to outperform private banks? Or now, is it better to invest in private banks? So in this video, I would explain the fall and rise of PSU banks and then share my thought process on where I see better opportunities between private and public banks. Just a disclaimer, this video is only for education purpose. The idea is to share my knowledge and help you make informed investment decision. Alright, let's get started. So first of all, let's understand what factors decide if a stock would create wealth or not. So first is EPS, that is earning per share growth, and second is valuation. If EPS is growing at a fast rate and valuations are cheap, stock price would jump and would generate great return. On the contrary, if EPS growth is slow and valuations are expensive, stock price would fall. For example, today chemical sector falls into wealth destroyer bucket because their EPS growth reduced significantly and they commanded expensive valuation. And PSU stocks fall into multi-bagger bucket because their EPS has grown at a fast rate but valuations were too cheap. But when it comes to the banking sector, you can't just look at EPS growth. Here, one very important metric is asset quality. A bank can continue to grow its EPS, but what if that growth comes at giving risky loan? So everything might look great during the growth phase, but if the borrower defaults on payment, bank NPA would shoot up significantly and that would result in sharp fall in EPS. One great example is Yes Bank. It was growing at a fast rate, but it was at the cost of riskier lending to corporate houses that other banks denied giving loan. Eventually, its borrower defaulted on payment. As a result, its NPA zoomed and profit tanked. And Yes Bank became one of the biggest wealth destroyer. So apart from EPS, it's very important to track the loan growth of the company as well as the loan book breakup. And that also decides the valuation the bank would command. So historically, private sector banks always commanded a premium valuation over public banks because they were more efficient than public bank. They had higher profitability, better asset quality, as well as higher EPS growth. Then another reason why investors preferred private banks over public is due to the loan book exposure. Public sector bank has maximum exposure in industrial sectors such as infrastructure, road, steel, power, telecom, and these sectors struggled badly during 2010 to 20 period. As a result, public sector bank had a very high NPA and nobody wanted to invest in public sector bank. Everyone wanted to invest in well-run private banks. As a result, between 2010 to 20, this valuation gap between public and private banks widened significantly. So before COVID, while SDFC used to trade at price to book of 4.5, Kotak used to trade at price to book of 5.4, and ICICI Bank used to trade at price to book of 3. PSU banks like Bank of Baroda commanded price to book of 0.5. SBI commanded price to book of 1.1. Punjab National Bank commanded price to book of 0.6. By the way, the right metric to gauge banking stock valuation is price to book and not price to earning. Price to book is the price investors are willing to pay for each rupee of company's net worth. So basically, PSU banks were trading at ultra cheap valuation. And rightly so, because their earning growth was poor, asset quality was bad, operational efficiency was bad, and they had higher exposure in riskier lending to corporates and infrastructure sector. So public sector banks were in first bucket. However, eventually things started changing. There was a huge restructuring that happened in PSU banks where many banks got merged to improve the efficiency. More of the asset quality of PSU banks improved significantly due to two key reasons. Government support where they write off the bad loan, and second is turnaround in the infrastructure sector. In fact, the infrastructure boom in India has resulted in very high earning growth for PSU banks. So post-COVID, PSU banks became more efficient, asset quality improved significantly, and earnings expanded due to the boom in infrastructure sector. Since public sector bank used to trade at ultra cheap valuation, investors started showing interest, and eventually they shifted to second quarter and generated multi-bagger return. The question here is, how is the valuation of public sector bank today, and is there more scope for growth? Let me show you the valuation analysis that I've done for public versus private banks. So this Excel sheet would give you a fair idea of valuation between public versus private sector bank. Now there are quite a few insights that I have generated out of it. So first of all, if you look at the asset quality, today banking sector has got the best ever asset quality across private and public sector bank. Look at this, majority of banks have NPA below 1. So if I just sort it, out of 22 banks, nearly 17 banks have NPA below 1. So what it does is, it gives a lot of confidence to bank to expand their loan book. So it means that banking sector loan book should continue to grow, and that should continue to grow their earning per share. Then second inference is the exposure to your retail versus corporate loan book. Interestingly, if you look at, if you just sort it by high to low, you'll find that out of top banks with exposure to retail loans, majority of them are private bank, except for one public bank, and your below exposure, where basically your lower exposure to retail loan, you've got public banks. Now what it means is, basically your private banks are more aligned to retail loan book, and public loan book is more towards your corporate loan. Now during the upcycle, when your corporates like infra sector, your power sector, they are doing very well, obviously the public banks are also doing very well. But at the end of the day, lending to corporate loan is quite risky, because during upcycle everything looks great. However, when the down cycle start, your NPA get shoot up, and that's what happened during 2016, 17, 18 period, and that's where I like to keep exposure in private bank where they've got higher exposure to retail loan. Then third insight is the profitability. If you sort the ROE, you'll find that majority of top banks with high ROE are from public sector. Except for Axis, you've got Bank of Maharashtra, Canara, then Bank of Baroda, SBI, they're all public banks. They've got very high return on equity. So this is again a very important metric to consider while investing in a bank, and this is again a very interesting insight. Now next insight is on the returns. So what I've done is, I've identified the price 1 year ago and identified the change in share price. And look at this, what a kind of crazy return generated by banks. And look at this, all of them are from public sector bank. Like out of 22 banks, 9 are public sector that have generated nearly 100% or more than 100% return. In fact, some of them have generated 180, 150% kind of return. And interestingly, if you look at the worst performer, they're all from private sector, right? In fact, the top 2 performers of almost a decade between 2010 to 20, Kotak and HDFC are the worst performer in last 1 year, right? So clearly your public sector banks have outperformed in last 1 year by a big margin. Now because of crazy return generated by your public sector bank, the valuations of these public sector bank have increased significantly. Let me just show you the breakup of private versus public valuation. So look at this. Your Axis Bank is currently at price to book of 2.7. It used to trade at price to book of median price to book of 2.3. So just about 16% above its median 5-year median. Kotak Bank, interestingly, is currently at price to book of 3, and it used to trade at peak price to book of 5.8. So nearly 48% correction in the valuation, and its median price to book is 4.2. So now it is down 28% from its median price to book. Then if you look at HDFC Bank, it is at price to book of 2.8 versus peak price to book of 5.8. So more than 50% correction in valuation, and its median is 3.7. So it is down 24% from its median valuation. If you just sort it, let me just sort it by low to high. Look at this. All of them are private banks where the valuations have corrected significantly, right? So this would give you a very good idea of what I'm talking about. And if you sort it by high to low, look at the kind of crazy expansion in valuation. Your Central Bank of India currently is at 1.96, 5-year median is just 0.5. So there's a crazy expansion in valuation. Now obviously these public sector banks commanded very low valuation, and there was a scope for valuation re-rating, and that is what has happened. But after a point you need to ask, what is the valuation that you want to pay to these PSU banks? For instance, your Indian Overseas Bank is trading at a price to book of 5, which is the highest. I mean, not even private banks command these kind of valuation, and its median was 1.7. So such a crazy expansion in valuation, and this is what is worrying me. I think majority of valuation expansion, in my opinion, has already been done. Now if you just sort it by public versus private, there is still some scope, in my opinion, where you have can be some valuation expansion. For example, those banks that are trading at valuation of 1.3, they can still expand to maybe, let's say, 1.5, 1.8, but I won't be comfortable paying a price to book of about 2. So that is my limit. I don't want to pay a price to book of about 2 to these public banks. So there's still some scope in the PSUs where there can be some more expansion in valuation, but still I think majority of valuation expansion has already happened. So I hope you got a fair idea of the valuation analysis. One last thing I want to discuss that I missed out is if you look at some of the banks like Indian Overseas Bank, they have got very low float. For example, they've got 96% stake with promoter and just 2% stake with public. So this is a very alarming situation, because during good times these banks would do very well, but during bad times, when people don't want to own the bank, there can be a sharp correction. Likewise, you have got UCO Bank that has got 95% stake with promoters. So there's a very low float, which means a very low percentage of stake are with public for trading, right? So this is again a risk that you need to keep in mind. So this analysis clearly suggests that on one side, while public sector bank valuations have expanded and are now already trading much above their median valuation, on another side, private banks valuations have tanked significantly and are trading at much below valuation as compared to the median valuation. And even the valuation gap between your public sector bank and private banks have narrowed down significantly. Hence, going forward, the growth in public sector bank share price won't be much from valuation expansion. So in my opinion, the multi-bagger return days are over for public sector bank. Now the growth in share price would only come from earnings expansion, and that would be limited. But obviously stock market in the short term is driven by sentiments, and today everyone is recommending buy on PSUs. So from here, if public sector banks continue to grow at exponential rate, they would become super expensive. They have already crossed their median valuation, and any further growth over and above EPS growth would make them expensive. Having said this, since public sector banks have best ever asset quality and infrastructure sector in India is still booming, if this infra rally continues, and as long as public sector bank asset quality does not deteriorate, public sector bank would continue to do well. How long? I don't know. But remember that higher exposure to infra sector would pose higher risk of NPA. So you need to keep a close eye on NPA, because eventually when things would turn ugly, PSBs can be impacted badly. On the other side, private sector banks have more focus towards retail loan and lower exposure to corporate and infra loans, and hence their lending is less riskier, which is more sustainable in my opinion. And since private banks are now trading at much attractive valuation, the risk rewards are extremely favorable for private banks. Another weakness for public sector bank in my opinion is digital banking. Over the last few years, traditional banking is replaced with fintech, and private banks have transitioned their business to digital platform at a much faster and efficient rate than public sector bank. So I'm not sure if PSBs would be able to provide that seamless digital banking ecosystem to retail segment that private banks offer today. So personally, as a long-term investor, I always like to bet on private banks. Yes, public sector banks were very attractive a few years ago, but honestly speaking, nobody really gauged this kind of growth in PSBs. Very few people invested in PSU banks during COVID level. And today, I see everyone talking about public sector bank when they've already rallied exponentially. So if you're a short-term investor and looking to park your fund for let's say 1 year, public sector bank might outperform private banks in the near term. But if you're a long-term investor with let's say more than 3 years of horizon, my suggestion would be to have a close look at private banks. I strongly believe that in the long term, private banks would outperform your public sector bank, especially after a very good correction in valuations today. Personally, as a long-term investor, I am adding some private banks in my portfolio systematically. If you want to know where I have invested my own money, you can explore my weekly video series that include one exclusive video every week. The idea is that majority of you would have a job or business and won't get enough time for research. That's where I try to add value, where I spend nearly 8-10 hours a day and share my own investment strategies, along with tracking more than 200 quarter results. You can get the details on my website or via the join button on this channel. So now that traders and investors have made money in public sector bank and private banks have not done very well, if situation changes in the future and public sector bank don't do well, traders and investors might book profit from public sector bank and move that money to private banks. That's where I think risk rewards are more favorable for private banks in the long term. Or maybe if you want to play both short term and long term game, you can have exposure in both of them. But like I said earlier, keep a close eye on asset quality and don't expect crazy growth in public sector bank share price. I think crazy growth days are over. Now tell me in the comments, what is your take on private versus public bank? Do you think public sector bank would continue to outperform private banks? And where are you investing your money? If you find this video useful, do share it with your circle. I'll see you next video. Till then, take care.